Hi, this is Bitcoin Asset Research with Allers. Today I want to talk about why Bitcoin could easily hit 120,000 given the coming surge in fiat liquidity. This really comes from an article I pushed out on Seeking Alpha a few days back. This video will be a summary of this article. Bitcoin has been a proxy for global M2 liquidity. Here you have BTC in black and the blue line is M2, global M2 supply in US dollars. And as the blue line goes up, so does the black line. As the black line goes down, so does the blue line. So this really is all you need to see that there's this strong correlation, and Bitcoin is this proxy for global M2 liquidity. So that's the most important factor, the increase in fiat liquidity. This really shouldn't be surprising. Bitcoin has no top because fiat has no bottom. This is commonly uttered in the Bitcoin community. The more M2 increases, the more there is currency debasement, and the more people will need some form of neutral sound money. This is the US dollar, the global reserve currency. The purchasing power of a single dollar has absolutely been annihilated over the last century. So let's first do an overview of how fiat works. Now, it's important to note that what I'm about to say applies to all major central banks in fiat currency. So the Bank of Japan, which runs the yen, Bank of England, which runs the pound, People's Bank of China runs the renminbi, and the ECB runs the euro, and of course we have the Fed, which runs the US dollar. Now, central banks issue fiat money in two forms. There's bank reserves and physical cash, or sometimes called banknotes. And this is collectively called base money, or M0. Now, M0 is then multiplied via fractional reserve banking. How does this work? So you can see on this chart, we have $100 worth of base money can be put into a bank. And again, fractional reserves, this is where the name comes from. Only 10% of it is held in reserves, and then 90% can be loaned out. And then that 90% ends up in another bank where the same thing happens. 90% is loaned out, 10% is kept in reserves. So you can see that right here, the 90% that are loaned out starts to increase the supply of this original base of $100. So right over here, you have $90 and $81 floating out in the economy. That's already $171 outside of the initial $100 deposit. And the way fractional reserve banking works is that this $100 can actually be multiplied into like $1,000 via this process of lending and reserves and lending out again. So all of that money that was created via this process is collectively called broad money. And that is not strictly M2, but they're basically monotonically correlated. So there's two avenues of money creation here. There's base money creation, which we'll talk about next, and then there's also broad money creation, which we just talked about. Now with base money creation, this is basically what happens. As the US debt grows, the government must borrow more money to pay down the debt that is due. All right, it has to service the interest payments on the debt. It has to take on more debt in order to do this. And it's kind of like a credit card debt spiral where you've messed up on payments and now the debt's ballooning out of control. That's basically exactly what's happening. Now, if you enjoyed this video so far, I just ask you to like, subscribe, share, comment. I started writing just to hear some challenges to my thoughts, so I definitely appreciate constructive critiques of all forms. So how is this borrowing done in the case of the US government? The US Treasury sells securities. These are Treasury bonds or Treasury bills. And if nobody buys it, the Fed actually steps in. It creates the M0 and credits it into the US Treasury's bank account at the Fed. And now the US government has money to spend via this M0 that was just created. And there's a major catch-22 over here, because compound interest is an exponential function. Debt compounds exponentially. The growth rate's going to go higher over time. Now, more US debt's going to mean faster compounding. Higher interest rates on that US debt is also going to mean faster compounding. And faster compounding means more M0 creation because, again, the government needs to create more money in order to pay that debt, which means that more M2 is going to be created via fractional reserve banking. And higher rates will normally restrict lending. I should definitely make this point clear. Higher rates do restrict lending. And that decreases M2 because it decreases the fractional reserve banking activity. But M0 creation will also increasingly become this dominating force because as the debt starts to spiral out of control, you're going to see the compound interest become an increasingly powerful factor in this equation. So that will eventually become the dominating counteractive force to all of this. So what about lower rates? Well, the Fed just did a 50 basis points cut. That definitely alleviates burden on the near end of the yield curve, but it also incentivizes more lending, and that increases M2 via fractional reserve banking, and that will be inflationary. Rate cuts, rate hikes, M2 is going up no matter what. Now, fiat is a debt-based monetary system, and fiat monetary units are designed to endlessly expand in quantity. Inflation is going to go substantially higher from here. And we'll probably see the Fed abandon its 2% inflation target. It won't be like a direct message saying 2% is no longer feasible. That would cause pandemonium in the markets. But you'll probably see this quiet pivot away. They'll mention inflation less. They'll focus on the unemployment part of the dual mandate. Now, I'm not saying any of this is inherently morally wrong. Economics is a positive discipline. We don't really care about moral opinions here. It's just reality that moves the needle, folks. So here's the reality. M2 is going much higher worldwide, and Bitcoin is a proxy for M2 liquidity. So the writing is on the wall. What are the risks to this thesis? Well, the main thing I think is sell walls, right? You're going to see profit taking all the way up to 100K. There's that halving hype that hasn't materialized. ETFs and paper Bitcoin, people are theorizing, is that a vehicle for price manipulation? I don't really think so. What I think is happening is that whales have been selling. There's endless reasons to sell. There's only one reason to buy. So you're just going to see some selling on the way up, and it's going to create for a choppy path up. But overall, the fundamentals of Bitcoin has not changed, and has not changed in all the years that Bitcoin has existed. We still have 10-minute block times. We still have 4 megabytes per block and 2.1 quadrillion indivisible hard money units. And then when we look at the River report that came out this month, we see even more bullish stuff. Bitcoin adoption growing by 30% year over year for businesses. This is definitely some bullish news. One day every Bitcoin will belong to entities who will not sell for any fiat price. And then what would you say the fiat price would be if no one is willing to sell for any price? Do you know what that is called? It's called Hotel 17 November, aka hyper Bitcoinization. That's the long-term bottom line here. And that concludes this video. Thanks for watching. Leave your questions in the comments below, and I'll see you in the next video. Bye.